we feel like it's our responsibility to make sure that we provide all the options to our lenders so that we can mix and match, we can configure, we can determine what is the best fit for each lender because it is not a one size fits all. That's why is Xactus even spending the time and money and the effort to implement this direct model? It's about adding competition and adding flexibility into the market to make sure that we are enabling our lenders to have as much flexibility as possible.
Shift happens, opportunities change, and success is a choice. So when shift happens, it is our choice. Either we let shift happen or we can make shift happen. Hey, everybody. Welcome to the Talkin' Shift podcast. I'm really excited to invite our special guest on today. And this is definitely going to be a conversation that is so timely in our market, throughout the mortgage industry, throughout the credit side of our industry. And I'm proud to welcome two very dear friends of mine as I've gotten to know, Shelley Leonard, CEO of Xactus, and Greg Holmes, Chief Revenue Officer of Xactus. And I cannot express enough about their leadership and their strategic thinking and how they have built this growing company and this very special company that has entered into our business over the last, 5+ years. And to get to know what Shelley and Greg are doing and how they're helping lead the company and lead the charge into a strategic position into the company. Correct me if I'm wrong here, but I think 1 in 3 credit reports throughout the mortgage industry is pulled through Xactus. And kudos to you guys and congratulations, because that is no small feat. And so I'm really excited. You guys, welcome. And, let's have a little fun. This is going to be a very interesting conversation with everything going on. So, welcome to the podcast.
Yeah, thanks for having us.
Yeah, my pleasure. My pleasure. All right. So let's jump in. I mean, look, we've got a lot of headlines going on, and regardless of just the mortgage industry, the headlines in the market right now with what's going on with FICO, the bureaus, everything around the credit report side of it. And that's just one component of that. But maybe, Shelley, can you kind of help pull out and sort of let's kind of deconstruct what's going on in the headlines? And I'll just kind of tee it off like, hey, FICO's going to go direct. Awesome. What does that mean?
Good question.
Right?
And I would say still we don't have all the answers, but hopefully we can shed some light on it based on what we know and where we are right now, with more to come. So maybe we'll tee up other conversations as things continue to evolve here, right? So, I think that it's no surprise to the industry that over the last 3 years, the cost of credit has gone up exponentially, right? And so that's been a topic of discussion. And because we obviously, as you said, sell credit reports and other products into the mortgage market for over 30% of the market, we are at the center of those conversations a lot. And I think Greg could say in the last, 2 weeks, Greg, it's been 80% of your conversations, if not 90% of your conversations. And as we continue through this process, it'll be 100% of his conversations tomorrow for the next few weeks until we round up the year. So again, topic of conversation, and it's something that's very important to Xactus. It's something that we talk about with our clients every day, really around how do we help our customers understand the data, understand their processes, their underlying workflows, and ultimately optimize that to reduce waste. So it sounds odd for a company that sells data to say we want to help you order less data, but that is really what we're all about at Xactus. And it really is because of that backdrop that credit costs have been increasing over the last few years. With what's also been going on in the mortgage market related to where volumes are, that's a really hard thing to stomach, right? Because if volumes were at an all-time high, we probably wouldn't be having this conversation because everybody would be worried about production and turn times and close rates, and we wouldn't be having these conversations. But because the volumes have been muted for so long, but prices are going up, it's just we're at an inflection point, I feel like. And so it is a big topic of conversation. That, coupled with the modernization initiatives, is kind of how all this FICO direct stuff comes about. So we can talk about what it is, but I think it's important to understand the why a little bit, as to why are we even talking about this? Why would FICO make such a move? Like, why is this even necessary?
Well, and I wanna dig into that, but I wanna illustrate the point that you just made, for right? I mean, one of the biggest challenges in the mortgage industry, especially over the last 3 years, with volume, call it margin compression, competition, everything that's entering into the space, and we are at an inflection point, and cost to produce is one of the biggest challenges,
Right.
and so here we are now, and that's just at a mortgage manufacturing line, so to speak. And so now when we have these headlines and it's confusing. And I think a lot of people, and I can come from a customer side, for me coming from the mortgage side, I never paid attention to how credit reports even worked.
I haven't thought about this because it's always just worked the way it's worked, and in all reality, there wasn't a lot of change that was happening, so you didn't worry about it, right? So, but now everyone's kind of going back to the fundamentals. So it is the right question to ask, which is how does it work today? Because it's important to understand how it works today to then understand how the direct model changes that in the FICO
Yeah.
announcement. So how it works today, you've got three major credit bureaus today: Experian, Equifax, TransUnion. What they do, their job is to aggregate files on consumers related to their credit across all the different places that a consumer like yourself may have credit. All these different types of credit that you have as a consumer get aggregated by the bureaus. And how does that happen? It happens because furnishers, so we use that word in the credit space, it just basically means the people that you owe money to, they're servicing your debt, the people that you make that payment to every month, and those those people that are tracking how much you owe them, and are you paying your payments on time? How much is your payment on a monthly basis? Have you been delinquent in the last 12 months? They send that information into the credit bureaus on some frequency. It's not
Yeah.
always the same frequency. It's not always the same time of the month for every furnisher. And it's not all the same furnishers at all the three of the bureaus. That's an important concept that we'll come back to, but that's something to remember. Historically, it was very regional. It's not regional anymore, but there are differences across who contributes data into the credit bureaus. But the credit bureaus aggregate a file on you, Craig, and you have a file at Experian, you have a file at TransUnion, you have a file at Equifax. They may not be exactly the same, right? But you do have three files. So that's where it starts. And then what happens is a request comes in from a new consumer working with a mortgage loan officer. One of the first things that a loan officer would do is request a credit report.
Uh-huh.
So that request would come through an LOS typically into a provider such as Xactus. We receive that request in our system. It's called Xactus 360. And then we make a request out to the bureaus, right? So we take in the request from the lender, and then we source that request out to the bureaus and say, okay, I need Craig's file. In addition to Craig's file, I want you to provide me a FICO score. And so the bureaus aggregate that file on Craig as of that date, and they send it into the FICO algorithm that they have at each of the bureaus in their clouds, and they calculate your FICO score. They append it to your credit file and they send it back to Xactus, and then Xactus aggregates those three different files into a tri-merge report, and we send it back to the LOS. So that's the basics. That's the fundamentals of how it works today.
Okay, so let me repeat this back to you. So obviously we go to order credit. So there's going to be multiple events that happen through this process. We go to order a credit report. That credit report request goes to Xactus. Xactus, so there's an event right there. Xactus then goes to three separate bureaus to request three pieces of information. Try merge that together. Xactus, you are then going to FICO.
Not today. So today, the bureaus
Okay.
actually calculate the score using FICO's algorithm. So it's FICO's IP. Think about it that way. It's FICO's,
Got it.
we
Got it.
call it
Got
the
it.
black box because we don't know what's in it. We don't know exactly how they're calculating. We know exactly how the algorithm works.
It's like the
But it
Coca-Cola recipe.
exactly, credit data goes in, FICO score comes out, right? And then with that FICO score, they attach it to that credit file, and then they send that back to the tri-merge providers such as Xactus.
Yeah. Yeah.
So that's how it works today, all within the bureaus controlling the creation of the credit file as well as the calculation of the FICO score.
And Xactus is a reseller of that information.
That's exactly right.
Yeah.
So we receive that information, we don't alter it, we don't change it, we aggregate it. We may simplify it in a human readable form so that
Yeah. Yeah.
humans can understand what it means and not just the ones and zeros in the data file. And then we will create a PDF so that they can understand it and understand hopefully what's most important to analyze towards their underwriting of that loan. But all of that really comes through to the lender through, Xactus as a conduit, as a channel. Think about it that way. But we're not the ones that are actually aggregating the individual credit files and or calculating the score today.
Yeah. So, and I think that's really important too, because again, just even going back to the very basics of how this thing works, I think what's important to illustrate is there's multiple events that happen through this process. It's no different than as an originator, and I want to offer a rate to my consumer. There isn't just a straight rate. There's multiple components that feed into the rate, from the capital markets price, the GSCs and how they price in, the company margins, the loan officer margins, and other things like that. And eventually we arrive to a rate.
That's exactly right.
So, and Greg, maybe, because you and I, we've been touching on this. So, okay. So then all of a sudden we have this announcement from FICO a month or and change ago that says, well, hold on a second. The headlines say FICO can now go direct. The confusion begins to happen now. Well, maybe we don't have to go through all of that. FICO can just go direct to the lender. Break that down, because there's confusion in that.
Yeah, the terminology definitely is confusing people, where they feel like they can contract directly with FICO, buy the score, and apply to the credit data that they buy from us or even the bureaus. And that's not necessarily the case. Back to your point on the FICO model or algorithm being proprietary, or the secret sauce, the Coke recipe. They're very protective of that, obviously, and it's IP.
Yeah.
So they historically have always been direct with the bureaus, and this change is a big change for them, because they're now moving that algorithm over to our side of the fence, so to speak. So when the events take place that you mentioned, the data would come to us directly from the bureaus, and then we use the same algorithm from FICO that the bureaus would use to calculate the score, stamp it, time and place, and then deliver the file directly to the lender at that point.
Yeah.
All
And so
right.
it's interesting that the old way of doing things, the current way of doing things, think of it as a wholesale model. So they're calling it the indirect model, whereas now this new model that Greg just described, where tri-merge providers such as Xactus will have the opportunity to calculate the score on the credit data provided by the bureaus, they're calling the direct model, which is a little bit confusing, but that's where that word direct came in. But it's direct through the resellers, not direct to a lender.
And that's a
Great
very
point.
clarifying point. And by the way, I have not heard that in the marketplace. That's why I think this conversation is really important to, so we can create some clarity where otherwise there is, confusion, because, and I'll go right to it. Okay, well, when I hear the headlines, and we already know there's a big challenge in cost to produce, throughout the mortgage industry. Great. Well, if we're going to go direct, then I think we should have a lesser cost of credit. But we're seeing that's not actually happening from, all these different moving parts. Is that something that, I mean, why would that be translating differently than maybe what we would otherwise have assumed?
Yeah, historically speaking, anytime that we have bought data or the score from the bureaus, that is our cost. And then, we take that data, and then we obviously provide it to the market. In today's terms, 2025, what happens with the score is that the bureaus actually make money on the score. And they mark that up before they resell it technically to us,
Mhm.
and then we distribute to the market. And then by going to this new model direct, most people go with the assumption that, we're cutting the middleman out in this case. But what is actually materialized is that the price of the score has actually changed. So the price to use the algorithm to generate the score has actually increased. And the markup that was originally taken by the bureaus, that's been removed from the bureaus under this distribution path, and the score price going up, in fact, pretty much eradicates that middleman markup being gone. And so now it flows down. Even in addition to the price of the score alone, there's data that costs a lot of money as well. and you couple the score price going up with the data cost going up, and that's how we get to the material increase that we're going to see in 2026.
Yeah.
Yeah,
That
yeah, and I think it's important to think about it. I think a lot of the press that gets out there and a lot of the coverage focuses on a component. What's happening with the FICO component price? What's happening with the credit data component price? There are lots of components that go into creating a tri-merge, but people don't buy just the credit data or just the FICO score. You buy a tri-merge report. And so you can't piece part it out, right? You have to have the whole. And so we have to make sure when we're thinking about overall costs, we're thinking about the whole because that's the whole that the industry needs.
Mm,
So it doesn't do them any good if they just get one piece of it. They need the whole thing. And
right.
so we have to look at it holistically. And sometimes, depending on where the information's coming from, they may just be talking about their component of it, right? So I think that created some confusion. And I think that, Greg, when we were talking about it earlier today, right? We think about it from the perspective of what was FICO capturing last year relative to the score
hmm
versus what was the market actually paying for the score. And so that's really what FICO's capturing. So when FICO says the price for the score is not going up, FICO knows and FICO published. I mean, it's not a secret, right? There was published information out in the press in 2025 that FICO's price for the score was $4.95. But the market price for the FICO score was closer on average to $10. So
Yeah.
the market mortgage lenders were paying $10 for a FICO score. So what's the price for a FICO score in 2026? It's $10. So is the price going up? Not no. You were on average paying $10 for a FICO score, and you're going to be paying $10 for a FICO score in 2026. Now, who's getting that money may have shifted some, right?
Right.
Where's that money going? Who's collecting on that $10? It was split between the bureaus and FICO. Now that $10 is going all to FICO, right? So, but the market price of the score is the same. But then the question is, now how much does the data cost then? And
hmm
so then that's where we go back to we have to look holistically to you have to get the credit data in order to get the score. So then what's happening with the cost of the credit data? Well, it's also going up. So then holistically, your price, your cost, your price for a tri-merge is going up because of all these components stacked together. That's how I think about it.
Yeah, you're right. The other component to this and why a lot of this took place is around competition.
Mhm.
FICO has truly been the only game in town for 30 years. And, we've operated this way. And now that there are going to be alternative models that are going to be offered to the market, if I'm FICO, and I understand that, my product is being priced and distributed through three providers being the bureaus. Um, and all of a sudden there's another score alternative brought in. What am I doing here? Because Vantage score has obviously been talked about a great deal. I do think options are fantastic and we need as much flexibility and options in the market. It only helps lenders, but, if your competition was pricing your product and distributing it, would you feel real good about it? I personally wouldn't. And so I think that made them have to, think about the fact that here's Vantage, which is really created and was a collaboration from Equifax, TU, and Experian, and they have a competing product in the market. What kind of position from a competitive landscape does that put me in? And so I think what they did was smart, and I probably would have taken the same action, but this definitely had a ripple effect that went from, to Shelley's point, the market price is $10. Great. That's what lenders are going to pay this year, basically. But when you remove, $5 per unit away from one hand, and then it still stays on the product, but obviously the bureaus have taken a financial hit here. what do they do? And what's the reaction? And the reaction is that data cost basically is going to cost more. They have responsibility to investors and others, and they want to make sure that they're made whole and they're operating their business no different than anybody else. And so it's just created this whirlwind of price adjustment that the market ultimately is trying to navigate. And it's not all bad news. It feels bad. And yes, the price point it is what it is. But there are ways to navigate through this and there are alternatives. And some things we just simply can't control,
Yeah.
you know. So, you have to understand that if you can't control it, what can you control? In here, what we've done is looked at product offerings, innovation, and we've invested very heavily in technology so that lenders can operate smarter, to Shelley's point, to focus on data that's not usable, that they still pay for. And how can we help them operate in a more efficient manner to help the overall spend stay more manageable, so to speak? And that's been our drive. So, we're trying to focus on the things that we can control as opposed to the noise, the things that are
Mhm.
out there that, we're rolling with it, right? And
Yep.
we feel like we've got some really, really good solutions that we're excited about in 26. And we'll continue to do that. It won't just stop in January. It'll continue on for years to come, and we'll get better as time passes.
Yeah. I
Yeah.
think something else too that's important to understand, right? And it's just a little bit of how we think about things. So in addition to focusing on the things that we can control and trying to help, lenders fight through the noise to understand what the signal is here, what's important for them to understand, despite some of the competing information that may be coming at them all day, every day. What's important to them? How does it help them solve a problem? How does it help them better manage their business? How does it help them control costs in their business? Is also thinking about optionality, right? And that flexibility. So, again, what this new distribution model, the direct distribution model, it's not an or, it's an and, right?
Ah,
So, the existing model will continue to function just as it has for 30 years. Now we have and a direct distribution model. So there's
mhm.
optionality there. It's creating some more competition. It's creating some more flexibility for lenders, for providers such as Xactus to help lenders determine which model's best for them based on their individual business and how they operate their business. It may even be different by channel. Maybe my direct to consumer channel may look very different than my correspondent channel or my JV channel or all my branch channel. Like they could be different. And so that's where Xactus is focused on. Again, we want to offer all the solutions. And so that's why we've been, again, it was announced very early, that Xactus was the first one to adopt the direct license program with FICO. And it was a head scratcher, like, well, why are you doing that? Don't you have great relationships with bureaus? Absolutely, we do. And we'll continue to have great relationships with the bureaus. We're forming a deeper relationship with FICO. We rolled out the FICO Score Mortgage Simulator early this year, and that kind of started our relationship with FICO as they put out, their own simulator product and we rolled it out to the market. And so it's really about that flexibility and that optionality as the market evolves. We feel like it's our responsibility to make sure that we provide all the options to our lenders so that we can mix and match. We can configure, we can determine what is the best fit for each lender because it is not a one size fits all. And so that's really the why behind why is Xactus even spending the time and money and the effort to implement this direct model. It's not to not partner with the bureaus. It's not to not be able to offer Vantage. We will offer Vantage Score as well. It's about adding competition and adding flexibility into the market to make sure that we are enabling our lenders to have as much flexibility as possible.
And Craig, look, this conversation I think is also around change.
Mhm.
And, people typically, they don't like change. We fight against it. It's not comfortable. We don't know. There's lack of understanding. It creates fear, obviously. And when you've done something for 3 decades and you understand the ins and outs, and all of a sudden here is this massive curveball. um, I think once people, understand a little bit more and more education gets out there, then, they'll see that, but they won't feel that until they can operate.
That's right.
And we've not come to that date, right? So we've got to get, we've got to get there. But I understand the concern around uncertainty. I certainly understand the position around pricing and expense, especially in the market that we've been in for a number of years now, just puts a big emphasis on how money is being spent. And, I say this quite often that, the price of a credit file, score, and credit, I don't think it's as sensitive if every credit report turned into a closed loan.
That's
But
right.
but the problem is that 82% roughly end up on the floor and you have to pay for that. But you have no idea what a score is or what's on a credit report until you buy and look at it. So, and that's where we lead into, trying to operate a little bit better and getting
Mhm.
really smarter about how we do things, and obviously for lenders as well.
There's so much to unpack and I mean, with what you
Yeah.
got here's a through line that I'm hearing. It's strategy. The through line that I'm in hearing is it's not about product, it's about strategy.
Hmm.
And the fact that that's why this conversation I think is so important because, now I have a better sense of like, why would FICO make this move? Oh, okay, I sort of get that. There's a response, certainly
Mhm.
with Vantage Score entering the market, and they're probably making a smart business decision for FICO, but that changes the dynamic because we've got again lots of moving parts. And I think Shelley, to your point, well, we approach this from a strategic standpoint when we're working with our customers. So now let's look at this as what is our best options? And are we in the credit report business or are we in the data business? And I've heard you talk about data a lot. And are
Yep.
we in the data insight business? And I think so I love hearing that as you guys are approaching this. Okay, so now, and you said something really important there, Shelley, is it's not or, it's and. And
Mhm.
throughout the diversity and the different channels within, throughout the mortgage industry and how that's going to continue sort of shifting, it sounds to me like you guys you're positioned strategically. And I always say strategy is the elasticity between vision and execution. And if we can be elastic between that, now we know how to navigate.
Mhm.
And so I love that. And I know you guys are delivering more on that kind of data insight. We've talked about the IVP strategy.
Mhm.
So, Greg, I know you're talking to your clients right now and your customers, already starting to, as pricing is starting to come down from the bureaus, and now we're starting to ingest and digest, maybe troubling, but digest what, the impacts of this is. You said something to me earlier today that your clients are looking to you for
Mm.
counsel. And I think that is a really good signal to your guys' relationship and commitment to your clients, where it's not just a transaction, but again, going back to we can provide strategic advice so we can offer the best solution based off of your needs and your wants. But Greg, talk a little bit about, how, I mean, we're right in the moment of this happening right now. So the timing
Yes.
of this
Yeah.
conversation is very interesting. But talk a little bit about some of those reactions right now that you're experiencing.
Yeah, right now I think there's a lot of sticker shock. We've had a
He
lot of
stunned people into
conversations.
silence, Greg.
Yeah, 100%. And we've started to get some written responses back on what the impact's going to be, and it's been very colorful. Is probably the best way to put it.
Yeah.
And that's the sticker shock part. You used to pay X for one thing and now you're paying a lot more. Why? But, all of this it's around evolution and, businesses constantly evolve and so does the market. And as we're having these conversations around, around how this has all evolved, it's at a point now where businesses that have operated the same way for a long time, they have their process down and that's what's best for their business. And I'm not a big advocate for trying to force change a process from the position that we sit in. But when it has such a financial impact to the bottom line, they're kind of forced to look at, other ways to
Yeah.
do things. And, these conversations that we're having initially is, it doesn't feel great because they're looking at the bottom line. They're looking at how it impacts them right now, and they don't have time to digest, okay, what kind of opportunity does this create? And at the end of the day, once the dust settles and, people become more educated in what they can do, I think it does open up the consultative approach to say, all right, I know we've always done it this way. You know what? It's worked great. But you know what? A CD player worked great. There's not a whole lot of CDs that are out there these days. It's evolving, and it is forcing us to look at a better way for us to offer solutions to our customers, and we're here to do that. Not that we haven't historically done that. This is just a new spin. This
Yeah.
this is a new way for us to focus on this product in our product suite. And I feel like we're pretty good at what we do. We obviously can always be a little bit better if we step back and we have conversations and understand the 30-year way of doing it, or the way we've always done it, or even the last 5 years. There are alternatives. We just fall into comfort areas because it's always worked a
Sure.
certain way. And I think this is going to force lenders to change from a financial standpoint. But I think there's more benefit that they'll find in trying something new can
Mhm.
create efficiency. And there's probably other byproducts that will come out of that change that they'll say, gosh, why didn't we do this 3 years ago?
Yep.
But if it ain't broke, why
Well, and
address
I
it?
love it from that perspective because this change getting in kind of coming from the outside, right? And you having to react to the change creates opportunity, right?
Right.
Never let a good opportunity go to waste. Some really wise
Thank
man
you.
taught me that. And so really that's where our industry needs to think about that, right? Which is, hey, look, we haven't changed the credit space in a long time. There is a lot of opportunity there. It wasn't the biggest thing to focus on. It just wasn't. But now, maybe it is. And is it worth us taking the time and putting forth the effort and saying, we're going to take this lemon, being this big price increase, and we're going to turn it into lemonade because we're going to go down deep. We're going to look at our workflow. We're going to look at our processes. We're going to look at our technology. We're going to leverage experts like at Xactus. And we are going to find a better way to underwrite loans so that it's more efficient, it's more cost effective, and we can continue to serve our clients in the way that we want to serve our clients. I think that's the part for me that's exciting, which is, hey, there's change in the mix here. And so let's take advantage of that opportunity and let's think about how we really can have some transformation and some innovation. And I think the other thing that's really exciting is that, there's some big players in the market today that have a lot of data scientists. They have a lot of technologists, and they're able to do some of this. Maybe they do this on a regular basis where they're looking at their numbers and they're optimizing their workflow. But for the masses to do that in the market, that's much harder. So this change that then someone like a Xactus can democratize in the space and make available to all of the industry is really healthy, right? That's a great opportunity. So a small broker or a small correspondent lender can compete with somebody who's the size of one of the big IMBs because someone like Xactus can provide them optimized workflow solutions that are
Hmm.
embedded in our technology that they don't have to go build themselves or buy from somebody else. They just have to continue to order credit through Xactus like they have before. That's an opportunity for our industry to move forward. And that's the part for me that is so exciting.
Let me dovetail off that.
Yeah.
The score that we are using today is the same score in version that was the very first score, 1995. We have not changed the version of this score in our industry in 30 years.
Wow.
There are new iterations with Vantage, a FICO 10T. Once that's incorporated and used into the market, it will open up a bigger marketplace. There will
That's
be
right.
more scoreable consumers. The way the data is being scored will be more relevant on today's terms versus using something that's just historically been used. And it's not that new models haven't come out over the years. They just haven't been adopted and
That's right.
used in our industry. But if you look at other financial industries, they have done this. They have
Mhm.
incorporated this and they've seen some great results. So this isn't the end of the change. This is just the big splash. And this is the disruptive part, right? This is the part that doesn't feel great. But once we get through this and we start to incorporate new versions, more competition, I think that what you'll see is more consumers will get pre approved. There'll be more homeowners and it'll open up more options. so that ultimately it will serve the consumer. It's just right now, because of the market and because of the price points, there's a lot of negativity around it, and rightfully so. Completely understand it. And so that's why we continue to evolve ourselves, and how do we talk to our customers, and what position do we take, and when data is ordered, and focus on waste and all those things that we just spoke about. But the change will continue, and this definitely is not the end of it.
And the
Uh,
change is the right thing to do,
It
right?
yeah.
is.
It's
Ultimately
not,
it is.
"Oh my
Yeah.
gosh, this is so much change." It's how do we manage change effectively? How do we implement this so that it's something that we can operationalize and benefit from, but all with the security, safety, and soundness of the industry, right? We don't want to introduce new risks, right? So
Mm-mm.
we've got to be intentional with how we implement the change. But the right thing is not to say stop changing, right? The right thing to say, let's be smart about the change and let's make the change happen at a pace that we can all handle. So it doesn't disrupt production of loans, because that's what we're all about. It doesn't disrupt homeowners closing loans, right? Because that's important to them. But the change is good, right? We have to remember the change is good. It may feel, to your point, fearful, Greg, or it's hard. Why do I have to change? No one wants to change. But when you look back, you're like, oh man, that was good for our industry. That was good for my business. That's what we want the outcome to be for lenders.
And so the biggest thing, the takeaway here, I mean, again, we have change, we have challenge, but from challenge we have opportunity. And Shelley, like what you were saying too, especially again with how this business is going and the competition from the large IMBs down to
Hmm.
the smaller and whatnot, you said something very, very critically important, which is now it creates a way that the smaller person can compete with the bigger guy that has the bigger resources and the balance sheet and the technology and the data scientists and all the different points. That if I'm working with Xactus, and again, like we talked about, and Xactus is a strategically focused company, all of a sudden you're empowering and tooling me with those data insights, with the optionality for the best, call it credit, transaction. And I think, Greg, to your point, now I'm also seeking your counsel. Help me.
Hmm.
What do you advise that how should I implement this into my operational workflow? If I am to make a change, and maybe, and by the way, maybe if I've wanted to make this change, but I can't. It's too disruptive. But now,
Hmm.
because never let a good crisis go to waste, maybe now is the time to make that change because and here's something else. Because your competitors may not be doing it.
Mm-hmm.
And so it's a time of innovation. It's a time to get on our toes. So now all of a sudden I can compete somewhere and that's I think the opportunity. Maybe this allows someone to compete somewhere that they weren't competing before. Maybe it
Hmm.
allows someone to change their game. And where I give you guys kudos is because I know that you guys were without knowing this was going to happen a year plus ago, thinking strategically, thinking about IVP strategy, thinking about not just being and Shelley, you said it earlier when you said commodity. I don't know if you look at me, I kind of perked up for a second because because the credit report space, again, outsider,
Yeah.
credit report space has been a commoditized space. It's a
Hmm.
transactional space. So now
Yep.
we're going from commodity and transaction into, again, strategic partnership. That's
Mhm.
different. That's
It
binding.
is.
And and I'm so happy you guys said it because that is what feels to me like that is opportunity. Like I'm putting my mortgage hat back on, and that gets me excited. Like I want to dig in now. How do I make this a competitive threat against everybody else?
Mm-hmm.
How do you use it to your advantage, right? Instead of
Right.
sitting back and saying, woe is me, this is happening to me. How do
That's
we
right.
flip that coin, turn it on its head and say, okay, let's think strategically about this. How can I make this benefit my business?
That's right. And pull in my strategic partners to
Mhm.
help me do that.
Right.
So going into 2026 here, right? Give me a taste of where's the vision? Where are you going? Now, obviously, with all this going on, this conversation, leading into that, what is if we're on this podcast a year from now and we say a year from now, my God, thank God we did that. Thank goodness we did these things because look at the success as a result of that. What does that look like to you, Shelley?
Again, I'm going to go back to it's all about the IVP, right? The intelligent verification platform, right? So that might even be a 2-year look back statement then, because again, we've spent this kind of whole year gearing up and making sure that our platform had this optionality and this flexibility and was intelligent, right? So to me, that's where the excitement comes, is that I'd like to be able to look back and say my headline is, you know, X number of lenders are using, our dynamic ordering capabilities in order to optimize their ordering workflow based on consumer attributes. That's what I want to be able to say in a year, right? Because again, I'm moving away from that one size fits all where I always order a tri-merge up front. First step in the door, order a tri-merge, move to next step in the origination process. No. First step comes in. I want to understand a little about this consumer. Well, what data could I use to do that? What data could I use to evaluate the consumer without spending a lot of money before I know what is their goal? What are they trying to solve? Are they buying a new home? Are they, moving cities? Are they going for a new job? Or are they having a baby? Like, what's going on with this customer? What
Yeah.
are the important things, whether behavioral, whether credit-based attributes, property-based attributes? There's lots of things that we can evaluate to say, what's the best execution for this consumer? And not the best execution for this line of business or the best execution based on the channel you came to me through, the best execution for this consumer. I think we can start to get really personalized with how we think about how we're flowing that workflow through the origination process, because it's not about skipping steps. It's about optimizing steps and saying these are the things that are important based on this consumer's, what the product type they're looking at, what type of loan they're getting, what type of program they're in. Are they the first time homeowner? Is this their 50th home they've bought, right? There's so many variables there that you can use to optimize that experience. So I'm always thinking about, I try to always put myself in the lender's shoes and say, what's important from a lender's perspective? It's about their consumer experience. It's about them, getting someone in the pipe, keeping them in the pipe and closing that loan and then servicing that customer so that they come back around when they're ready to originate the next time. And so how am I enabling that through flexibility and through technology? Because again, the other thing that I really want to happen is for the market to continue to come back and for volumes to continue to increase, and to enable that through technology, so that doesn't mean we have to go hire a bunch of people until the next cycle comes, right? So it's those combination of those two things that I want it to be much more personalized, and I want it to be very, very focused on enablement through technology, not so that we're displacing people. That's not the point. It's so we can all scale as volumes increase, which is what we're all looking for.
And that's the magic word, scale. 100%. Yeah. Greg, what are your thoughts? What does a year or even 2 years look like for you?
I think a year from today, what we'll see is people are more tactical with the data. Right now, when they buy any verification service, to Shelley's point, it's broadly used. It's used for every loan type. And I'll use an example. Today people pull a FICO score and they use the credit reports or tri-merge that they use for a VA loan that they use for a conventional loan. But most haven't considered the fact that they could use an alternative score today for VA. Sometimes it's obviously you don't know necessarily what type of loan type you're getting into till after you pull credit. But by going through, this evolution, and hopefully by the end of next year, people will be able to get insights earlier on consumers, make the right decision on when to move to the next step in the verification process using automation, not having to take the time, to stare and compare and go through the process. And that's very manual. Like that's not the play. But obviously using the IBP strategy and going through cascading, at the end of the day, I hope that they look back and we're talking about how many units of data did we save people, because today they're buying them. And unfortunately, because it costs so much, they made, they had to look for alternatives as opposed to being a little bit more forward thinking to say, we should have thought about this when the price was in 25 or even 24, or gosh, go back to, 10 years ago. And now all the automation didn't exist at that point. And so it's progressively gotten better over time. But I do think that businesses will run more efficiently. And unfortunately, I do think it's more forced because of the financial impact as opposed to being more strategic. And again, you layer that with how fast technology evolves and moves. And now here we are. And then in 12 months, I think you're going to see that speed up. I also think, quite honestly, in a year, there will be more options. As far as what's accepted in the market. Uh,
Mhm.
and as far as scoring models and whether it's 10T or Vantage, it doesn't matter. And let's face it, if more consumers are getting into homes, it's a win.
That's right.
It's a win. And that is the end game, is more people will get into homes. Businesses will operate more efficiently, and and a lot of the catalyst for that is this. So again, we got to get through the heartburn, to get to the good place that will exist down the road.
I love it. All right, final question.
Yep.
All right, who wants it first?
Greg.
Shell.
Oh,
All right.
okay. I'll go.
All right, Greg.
All right.
If there's one word you want your audience, everyone listening right now, to remember in this conversation, what's your one word?
Innovation.
Shelley?
Optimization.
That's the word I wrote down as you were talking. Innovation, optimization. And throughout this conversation,
Optimization through innovation. They're connected.
There you go.
yeah, there you go. That's a better order, right?
Wonder twins.
Optimization. And I agree. I think the future is bright. We're in the moment of change, but this is where we lean on our strategic partners and we do this thing together. And I can't think of a better strategic partner in this space than Xactus. And I appreciate your guys' leadership and your commitment to, and notice the language too, to the consumer, to the borrower, to our lender partners. So thank you guys so much for being on. This was a great conversation. And this helped clear up, I think, a lot of confusion. So I appreciate you guys being here.
Thanks for
Thanks so
having us.
much. Yeah, it
my
was awesome.
pleasure. All right. Well, appreciate it. And everybody, thanks for joining us. And be sure to like, subscribe, and share. And we'll definitely continue this conversation. All right. Cheers. Hey, thanks for joining me today on Talking Shift. I hope you enjoyed it. And I'm looking forward to seeing you on our next episode.